welcome to MHA's latest webinar in our ongoing series covering topical, interesting, and hopefully useful subjects on the private client and entrepreneurial business area. Today's subject is wealth transfer and IHT planning, some of which we may have covered before, but we thought we needed just to remind you anyway, and some of which will definitely be new. As we have done in recent webinars, we're also combining this time with our investment planning business so that you can see how the two interact. And investment is obviously very key in a lot of inheritance tax planning matters. So thanks all for joining us. Could you keep your microphones muted during the presentation, because we find that we get an awful lot of background noise if you don't, and it sometimes has issues with the bandwidth as well. You are able to ask questions during the presentation. Just use the Q&A function, which I think is in the top of your screen. Just fire a question in there and we'll try and answer as we go along, and we are having a Q&A section at the end if at all possible, where we'll deal with questions as much as we can. If we don't get to your question for any reason, don't worry, we will try and get back to you separately anyway. So, speakers today, the person you're hearing at the moment is Patrick King, that's myself. I won't be saying too much today other than the introduction, but welcome again. The people doing the speaking, the real speaking as it were, James Kipping is going to take us through the private client inheritance tax side of things, and Dominic Thackeray, who is going to be looking at the investment side. So moving on to what we will cover today, James will first run through the basics of inheritance tax, a lot of which we may have covered in previous webinars, but we thought we just needed to remind you, and for people who haven't been on these before, of those basics. You need to know those things in order to really see what we're trying to do. He'll then move on to some very effective planning ideas that we use as often as the facts allow, and facts obviously are very important. Then we'll move on to the investment side with Dominic, looking at how you might structure financial products to help you with transferring wealth down the generations, the various stages of wealth transfer, depending on your age and your circumstances and so on, and also the vexed and difficult question of choosing the right financial products. I think that's everything I needed to say at this stage. So as I said, we've got an awful lot to cover, so I shall hand you over now to James. Thanks, James.
Thank you, Patrick. Right, I'll get straight on to inheritance tax and the basics. At least I hope they're the basics. I'll cover everything quite concisely, but feel free to ask questions at the end, as Patrick said. But when listening to tax presentations, Benjamin Franklin's famous quote on the screen here is often mentioned. In this world, nothing can be said to be certain except for death and taxes. Well, that's probably true. And in many cases, when it comes to inheritance tax planning, it must be accepted that it may not be possible to eliminate the exposure altogether. But the message here really is, by planning your affairs, often over many, many years, significant savings can be made. And hopefully what we say this morning will be some food for thought as to what you might do to improve your own inheritance tax exposure. So what is inheritance tax then? So in this first part, I'm just going to run through some of the main principles of inheritance tax, or IHT, as I would abbreviate this morning. IHT is principally charged on the value of someone's estate on death at a rate of 40%, although certain lifetime transfers, mainly transfers into trusts, known as chargeable lifetime transfers, are taxed at a lifetime rate of 20%. Trusts are subject to their own inheritance tax regime, known as the relevant property regime, which I won't go into detail on this morning, but we've covered in previous webinars. So do take a look back if trusts are a particular area of interest. Everyone is entitled to a nil rate band of 325,000, which is essentially the value of someone's taxable estate that can be passed without IHT. An additional residence nil rate band of 175,000 can apply where the main residence passes to direct descendants, but that's abated by £1 for every £2 that the value of someone's estate exceeds 2 million. So effectively it doesn't apply at all when the value of the estate exceeds 2.35 million. Both of these nil rate allowances are transferable between spouses and civil partners, so that in the right circumstances, spouses or civil partners can pass a joint estate of up to, or rather a joint taxable estate of up to 1 million without inheritance tax. Now, in terms of types of lifetime transfer, most inheritance tax planning revolves around lifetime transfers of assets. So whilst IHT is principally charged on death, it's also important to understand how lifetime transfers themselves are taxed. Now, as I mentioned, certain lifetime transfers or chargeable lifetime transfers, CLTs, are immediately taxable if they exceed the value of the available nil rate band. But other lifetime transfers are known as potentially exempt transfers. Most lifetime transfers are potentially exempt transfers, or PETs. Now, PETs are only liable to inheritance tax if the donor fails to survive that transfer or gift by 7 years. So if there's a death before the end of the 7-year period, the value of the PET is brought into their inheritance tax calculation. The nil rate band is first allocated against lifetime transfers, but if there are failed PETs in excess of the available nil rate band, the resulting tax charge can be reduced by taper relief, as set out on the next slide, and I'll bring that up now. So the rate of tax on a failed PET, so that's a gift that you failed to survive by 7 years, is reduced by 20% per annum after the donor has survived the gift by 3 years, until it is completely exempt after 7 years. It's often thought that taper relief reduces the taxable value of the gift itself, but the relief is not as generous as that. It only reduces the tax payable on gifts. So it's only ever really relevant if the value of gifts that become chargeable on death exceed the value of the nil rate band. Listed on this slide here are a number of exemptions from inheritance tax. Individually, some of these may seem small, but we encourage clients to take full advantage of them over a period of time, because they can be extremely valuable when compounded over a number of years. The annual exemption of £3,000 is simply the value of gifts that can be completely ignored in a tax year, even if the donor does not survive 7 years, and that exemption can be carried forward for 1 year if it's unused. Gifts to charity, just picking out a couple on the screen here, gifts to charity are also exempt. And in fact, if at least 10% of the estate is gifted to charity on death, this reduces the inheritance tax rate to 36%. So arguably, you get a better overall tax result by making gifts to charity on death rather than during your lifetime, albeit, that's not always or necessarily the case. One of the most underused but very valuable reliefs is the exemption for normal or regular gifts from surplus income. I believe Dominic's going to cover this a bit later in the presentation, so I'm not going to go into detail, other than to say that the exemption applies where the taxpayer can show that a gift forms part of the transferor's normal expenditure, so it has to be regular. It's made out of income or surplus income, and it left the transferor with enough income for them to maintain their normal standards of living. So it's important to show where we may need to claim this exemption, that there's an intention for the gift to be regular, even if it has not been made enough times to demonstrate this in actual fact. So we would often advise a written commitment to make a regular gift as good evidence that there's an intention for it to be regular. For example, regular gifts out of income might be pension contributions for children or grandchildren that one makes annually or what have you. Record keeping is obviously important, and we encourage clients in these circumstances to keep records of income and expenditure in the format that's required on form IHT 403, which forms part of the inheritance tax return. It's relatively straightforward, isn't particularly onerous, and will leave good records for those dealing with your estate when the time comes. I'm going to skip back actually to the previous slide, because at the bottom there, the most valuable exemption is probably the spouse exemption, which means there's no inheritance tax on transfers during lifetime or on death between spouses or civil partners. The exception here, which again we're not going into huge detail here, but the exception is where transfers are made to a non-domiciled spouse, in which case the exemption is restricted to 325,000 plus the available nil rate band. Although in those circumstances, the non-domiciled spouse can elect into UK domicile if it's beneficial for them to do so. I think that our message here really is that if there is a situation where there may well be transfers from domicile to non-domicile spouses, separate advice really needs to be taken. I explained earlier that the nil rate band, that's the 325,000, and indeed the residence nil rate band if it's available, is transferable between spouses and civil partners, so that to the extent it is unused on the first death, it can be carried forward and used by the survivor's estate on their death. Now, there are 2 points to bring out on this slide, really. Firstly, the transferable amount, this is actually bullet point number 4 here, I think. Firstly, the transferable amount is calculated by reference to the proportion of the nil rate band which is used on the first death. So if the first to die used 50% of their nil rate band, whatever the value of the nil rate band was on their death, the survivor's estate will be able to claim 50% of the prevailing nil rate band at the date of the second death. The final point, here's an interesting one. An estate can only claim a maximum of 1 additional nil rate band, which, 99 times out of 100 is enough. But if someone has remarried after the death of a spouse, more than 1 transferable nil rate band might technically be available. So this should be considered when drafting wills, so that where multiple nil rate bands are available, so that on the death of a married, or on the first death of a married couple, some assets might be bequeathed otherwise than to the surviving spouse, so that we are able to use up available transferable nil rate bands from a predeceased spouse. Effectively, we're looking to try and benefit from more than 2 nil rate bands between a married couple or civil partners. Short slide here. It's also important to recognise or appreciate when looking at inheritance tax that IHT is a cumulative tax. So at the date of each transfer, whether that be during lifetime or on death, we must look back and take into account transfers that have happened in the last 7 years. So what's the relevance of this to planning? It means that the nil rate band is allocated to lifetime transfers before the death estate. So care sometimes needs to be taken in understanding who, in terms of beneficiaries or what assets, will ultimately bear the IHT that's due. It also means that if there are chargeable lifetime transfers, that's essentially transfers into trust during lifetime, they use up some or all of the nil rate band immediately, and individuals will have another nil rate band available to them once 7 years has passed. This is why individuals might consider creating trusts with £325,000 every 7 years as part of their long-term inheritance tax planning. Finally, due to how the inheritance tax regime for trusts operates, if you're considering making significant pets, so that's gifts that you'd need to survive 7 years to fall out of your estate, and chargeable lifetime transfers, such as transfers into trust, it's usually preferable to make the chargeable lifetime transfers first. This is because in the event of a death within 7 years, if the pets were made first, they would then reduce the nil rate band available to the trusts, or trusts, and increase ongoing inheritance tax charges for those trusts. Again, this is getting quite technical, so the message really is, look, if we're considering significant transfers, do chargeable lifetime transfers before pets as a rule. Gift with reservation and pre-owned assets. Now, these are anti-avoidance provisions, which essentially prevent individuals from giving away assets for inheritance tax purposes and continuing to benefit from them. The most obvious example of a gift with reservation is where someone, say, makes a gift of their home, say to their children, but continues to reside there. Now, in that case, unless they pay a market rent for their occupation of the home, the value of the home will remain in their estate for inheritance tax purposes. Essentially, the planning is not effective for inheritance tax purposes whatsoever. It's rarely advisable to gift the family home because of the gift reservation rules, but there are exceptions, and I'll come on to one in particular in the next section when we talk about some planning ideas. The pre-owned asset tax rules, POAT rules, apply an income tax charge, generally in situations where there's been a disposition in such a way that someone can continue to benefit from assets or that disposition, but in circumstances which for some reason fall outside the gift reservation of benefit rules, beyond the scope of this talk, but it's here on this slide for awareness more than anything. Business property relief, you'd have heard us talk about this in the context of tax planning in our previous webinars. It's a hugely significant relief available for certain shareholdings, interests in businesses, and assets used in businesses, which as I said is hugely valuable, but particularly for our business owner clients. So 100% relief can be available for unincorporated businesses or shares in unquoted companies, including AIM shares, and far less common quoted securities that give the transfer or control. 50% relief is available for controlling holding of a quoted company, land and buildings that might be used in a business carried on by the transferor, land and buildings, plant machinery used in a partnership of which the member is a sorry, I've got confused on the slide here, but land and buildings used in the partnership of which the transferor is a partner. Okay, and when I say 100% relief or 50% relief, that's not a relief against the tax, it's a relief against the entire value of the business interest. So let's say in the case of shares in an unquoted family trading company, 100% relief should normally apply to completely exempt that value from inheritance tax. Now, there's a minimum period of ownership of 2 years before the relief can qualify, but there are replacement property provisions which allow you to come out of one asset, invest in another, and provided you've owned the business property for 2 out of 5 years, it will qualify. And further, if someone takes on business property on the death of their spouse, the ownership periods are aggregated. Okay. Important though is that relief is not available if the business is engaged wholly or mainly in dealing in securities, shares, land and buildings, or in making or holding of investments, or where the business is not carried on for a gain, or where the business or shares in a company are subject to a binding contract for sale. Perhaps the most important one I want to highlight here is that first one, where essentially the company needs to, or the business needs to be wholly or mainly trading for relief to be available. So business property relief is not available for investment businesses or businesses that are wholly or mainly involved in making or holding of investments. Even if BPR, that's business property relief, applies to a business asset or interest in a business, any value attributable to so-called accepted assets is also excluded from relief. Now, these are assets which are not used wholly or mainly for the business, or not required at the time of the transfer for an identified future business use, or where they're wholly or mainly used for a personal benefit. Generally speaking, other than in the case of assets used personally, surplus cash is the main asset that can be an accepted asset. And of course, different types of businesses will have different cash requirements at different times. So there's not really a rule of thumb as to an acceptable level of cash, but you should be able to demonstrate and keep records why it's required for working capital purposes. We do a lot of planning around around ensuring that our business owner clients benefit from business property relief to the maximum. And in terms of inheritance tax planning, I just want to run through 3 or 4 ideas here before handing over to Dominic. So first section is on will planning. It goes without saying, the first thing we will talk about, even though we're not lawyers and we don't draft wills ourselves, the first thing we will ask our clients in terms of an IHT planning exercise is about their wills. They must ensure they're up to date, and alongside that we will recommend that they consider powers of attorney, both for property and financial affairs and their health and welfare. And you can have separate powers of attorney for those aspects to ensure that your affairs can be dealt with should you lose capacity to deal with those yourselves. In terms of wills and how they should be drafted with inheritance tax in mind, quite often standard wills for spouses may be appropriate. And by standard will, I simply mean assets are left on the first death to the surviving spouse. Everything transfers with no inheritance tax because of the spouse exemption, and then the inheritance tax exposure arises on the second death with hopefully all the transferable nil rate band available to the survivor. That's the most straightforward of will planning. However, consider the following 3 points in particular. Firstly, couples may be in a situation where they want to avoid a so-called bunching of assets in the survivor's estate after the first death. If by restricting the value of a survivor's estate, it might facilitate a claim to the residence nil rate band. Now, you remember I said that the residence nil rate band, that additional 175,000 allowance, is available in full, provided someone's estate does not exceed 2 million. Well, if you've got a married couple with assets of 4 million split equally, if the first to die leaves all the assets to the survivor, then clearly the survivor's estate is going to far exceed 2 million, and the residence nil rate band won't be available to them. It might be possible to pass assets elsewhere on the first death to avoid that bunching and therefore increase the allowances available to the survivor's estate. The second point is consider leaving business assets onto a discretionary trust to bank the business property relief and provide an opportunity for further planning, so which I refer to here as double dip or double dipping for business property relief. That's in bold because I'm going to cover that on the next slide. And thirdly, and I did refer to this earlier, if one or more spouse shouldn't be there, but is a widow or widower, consider leaving sufficient assets otherwise than to the surviving spouse, so that potentially there's a possibility of more than 2 nil rate bands being claimed. The final point on the slide here is in connection with deed of variation. So, occasionally we have people say, well, okay, I'll leave my will as it is because we can always be varied within 2 years of death anyway. Well, that's often the case, but it's rarely as efficient from a tax perspective to redirect assets by a deed of variation to someone's will within 2 years of death than it is just to get it right in the first place. And furthermore, there can be significant difficulty in undertaking a deed of variation where there are, for example, minor beneficiaries, because of course they themselves cannot consent to a deed of variation. I think again the message is, look, don't leave this until it's too late. So in terms of will planning for business interests, and I mentioned consider using a discretionary trust in your will for business assets. I'll run through this by way of an example. So Mr. and Mrs. A's assets in this example are as follows. They have a main home valued at £1 million, it's jointly held, that's taxable. They have cash and investments, also £1 million, jointly held, that's taxable. Mr. A has shares in a personal trading company that qualifies for BPR. So if Mr. A dies first with a standard will, in other words, leaving everything to Mrs. A, all the assets will pass to Mrs. A with no inheritance tax. Great, you might think, and in fact it may well be appropriate. But on what happens on the event of Mrs. A's death? Well, if the company is still in existence and trading, its value will qualify for business property relief based on the rules today. So, there will be no inheritance tax on that £2 million pound of business interest. However, if the company's trading status has changed, or if the company's been sold, no BPR will be due. So potentially £2 million, or whatever the value of that interest has become, will be taxable in Mrs. A's estate and at a rate of 40%, and therefore create, in my example here, a liability of £800,000. The cash and investments will also be taxable. She'll have the nil rate band and transferable nil rate band to reduce the taxable value to 1.35 million, on which tax at 40% is 540,000. No nil rate band will be due. No residence nil rate band will be due because the total value of her estate is more than 2.35 million. So the potential liability in this situation is 1.34 million. Okay. If, however, on Mr. A's death, the shares pass on to a discretionary trust from which Mrs. A can benefit, by the way. So this doesn't disadvantage Mrs. A in any way. The tax position would be as follows. Now, business property relief would apply to the transfer of the shares from Mr. A to the discretionary trust, so there's no inheritance tax. The shares would be outside of Mrs. A's estate, so if BPR no longer applied on her death, there would be no charge to IHT in her estate. Therefore, there's a potential saving of £800,000 there. That there are potential tax liabilities arising to the trust, but nothing close to being as significant as 800,000. Mrs. A's total estate is reduced to 2 million because the shares of the company aren't in her estate. So her estate will get the residence nil rate band on top of the transferable and standard nil rate bands to reduce the overall inheritance tax exposure to just £470,000. So in this example, there's a potential saving by a straightforward clause in their wills. There's a potential saving of £870,000. Now, if the shares remain qualifying for business property relief whilst they're on the discretionary trust, and Mrs. A expects that to continue to be the case, she could do some lifetime planning to swap the taxable cash and investments in her estate, which valued at £1 million, for shares in the company, so that she then holds business property relief qualifying shares on her death, but no longer holds the taxable cash and investments. And this would reduce the taxable value of her estate by £1 million, saving a further 400,000 of IHT. This is the so-called double dip planning for BPR that I referred to a moment ago. I'm very conscious of time. I've not got too much left, 2 or 3 minutes, and I'll hand over to Dominic. So deathbed planning, this is a potential opportunity that arises where spouses or civil partners are in the unfortunate position where they know which of them will die first. So when assets pass on death to a spouse or civil partner, they pass without any inheritance tax, but they also pass at their date of death value. So that means for future capital gains tax purposes, assets are rebased to their date of death value so that future disposals can be made with no or less capital gains tax than would otherwise be the case. So in the event of knowing which of a couple are likely to die first, if assets are put into that person's name, they can then leave those assets back to the survivor in their will, thus generating that tax-free uplift in base cost without any inheritance tax charge. And that can, of course, facilitate a tax-free sale or gift of assets after the first death. I believe this is my second to last slide. Saying here, I think what's saying here is that shares in a family company will most often qualify for business property relief. That needs to continually be reviewed, particularly if profits are being retained and investments are being made within that otherwise trading company. The business needs to be wholly or mainly trading for business property relief to apply, and it's an all or nothing relief. So the actions for people in this situation are regularly review trading assets, or rather the trading status of the company for business property relief. It may be possible to restructure to preserve business property relief on the trading elements, and further consider gifting shares in unquoted trading companies before business property relief is lost. Now, this would be a PET for inheritance tax purposes, but in the event of a death within 7 years, business property relief is retained, provided the transferee has retained the shares. And that's the case even if the shares would no longer qualify for business property relief. So that's a bit of a quirk within the legislation, which you might take advantage of if you anticipate moving from a kind of trading to investment predominance within your business. And the final slide, and apologies for overrunning slightly. Planning with the family home is very, very difficult, but where children or adult children are in occupation alongside parents, a gift a gift of a part share in the home by the parents to the children is by statute outside the gift with reservation of benefit rules. Now, it means in this situation, if the parents give away a share of their home, they must continue to bear at least their share of the running expenses in order for these rules to apply. And whilst on a technical or literal reading of the legislation, it would allow parents, for example, to gift 99% of the home to the children and retain 1%, HMRC are very clear in their guidance that no greater share should be given than equates to the number of co-owners. Okay, and I've put a reference there to the guidance manual, should you want to take a look. And on that note, I've overrun slightly. My coffee has gone cold, and I will hand over to Dominic to finish up.
Thank you very much, James. So I thought it'd be useful to start off with discussing how, I suppose, financial products are structured to aid in wealth transfer, and how, I suppose, different structures can be used to assist and make it easier where possible. The first relates to, I suppose, financial structures that offer high levels of liquidity. Really, it's a case of being able to make gifts in an administratively simple manner where possible, make it clear with HMRC as to who the new owner of the asset is, because you would not want to fall foul of the gifts with reservation rules. Commonly, people might use cash or investments for this purpose. For example, shares are quite easy to transfer to another individual's name, though it's important to obviously make sure and take consideration to capital gains tax that may be due on the sale of such shares. Property can be quite a difficult one because transferring part of a property is generally an administratively costly exercise, generally requires legal advice as well. But you could structure, say, buy-to-lets or commercial property owned, for example, in a company itself, and you're then giving shares each year rather than the ownership of the property itself. So that gives the liquidity that you can require really to be able to make smaller gifts of, a company that encapsulates property. How investments are held could be a worthy area to consider as well. Looking at something like an onshore or offshore investment bond structure. So this is a tax wrapper that would hold investments within this. And when assigning segments of these bonds, there's not a trigger for capital gains tax in that instance, or your own income assessability either, because these segments are deemed to be owned by the new owner themselves, and when encashed in their own name, are taxable on their circumstances as well. So there's no capital gains to worry about when making those assignments. The next consideration really relates to trusts, who owns assets, and how loans can be used to kind of support the inheritance tax planning conversation as well. Really about making sure the right individual has ownership of the asset, and making sure that you take considerations from a tax perspective as well. One of the most important and simple things that can be done with a life insurance policy, for example, is making sure that the benefit is written into trust. The last thing you'd want is a life insurance policy payable to fall into your own estate and then be taxable on inheritance tax on death to then be passed to your beneficiary. Where you could write the policy itself into a trust, have it pay into the trust free of IHT, and then distributed from the trust to the beneficiaries that you describe within the trust terms. Loans could also be quite cleverly used to limit growth of assets. So this kind of puts a cap on that element of your estate to make sure that inheritance tax liabilities don't grow and get worse. It could be a form of an interest-free loan to beneficiaries, for example, or it could be a loan to a trust where growth belongs to the trust of the underlying investment held and the growth itself is immediately outside of your estate. With the kind of intergenerational wealth transfer conversation, the conversation around trusts isn't just a tax consideration either. Trusts allow you to stipulate terms under which the benefit may be payable, and you can appoint trustees to follow your wishes when distributing assets as well. So this can be particularly beneficial where looking to ensure assets are received by your bloodline, for example, because that individual wouldn't necessarily own it in their own name, with the consequence of that marriage and divorce, for example, or it could be used to help protect a vulnerable beneficiary as well. How investments are held within a trust are also important to consider as well, because the trust rate of tax is effectively the highest rate of tax that an individual would see. But what you could look at doing is using an investment structure like an onshore or offshore investment bond within the trust. That means that actually growth is held within the bond itself, and when the bond or segments of such is assigned to the beneficiaries, it's taxable on their own marginal rate rather than trust rate of tax. Particularly beneficial where you're looking at planning that involves maybe grandchildren, for example, because they may well be nil rate taxpayers, and therefore there are allowances that they've got individually that the trust wouldn't have to be able to offset any tax due on growth. And as James mentioned, with regards to taking advantage of the residence nil rate band if applicable, really it's about making sure that your will is structured in the right way and owning the property in joint names where possible initially as well, to make use of that allowance where available. Another big planning consideration is that you'll generally have assets already in place, and some of them may actually have quirks available or tax benefits available to them, that mean that actually that they're kind of the last thing that you'd want to touch in retirement, for example. Commonly, pensions, obviously we were all encouraged to pay into pensions used for retirement, but they actually are a very, very powerful estate planning tool as well. This is because pensions sit outside of your estate for inheritance tax purposes. Subject to the lifetime allowance of the pension being within this, a death before the age of 75, the pension value is paid tax-free to the nominated beneficiaries of the pensions. Importantly, it's very important to consider A, who you're nominating the pension to go to, and B, that it's not your will itself that nominates where the pensions go. The individual pensions are individual trusts in their own right, and you need to notify the pension companies themselves as to who you wish to benefit from the pension. After 75, the pension would still go to the intended recipient that you described to the pension company, but it would be taxable at their own marginal rate. But again, something that could quite powerfully be used because they could decide that actually they're going to elect to use it as part of their own pension planning and only access it in retirement, where they may be, say, a basic rate taxpayer, for example, and that's certainly better off than paying 40% inheritance tax. Some pensions or investment bonds might also come with additional death benefits as well. Sometimes there are guarantees attached to particularly older products that may mean that actually you'd lose that benefit if they were sold and used as part of your income planning, for example. Again, as James touched on, assets that qualify for business relief. Why, I suppose, would you touch assets that qualify for business relief and losing that exemption if sold, when actually you may have other assets in your estate that don't qualify for such reliefs that could be used instead first? This is really a consideration on the gift having been made, whether you're using annual exemptions, whether you're making a potentially exempt transfer, for example, but what the recipient is going to be doing with that gift, because ultimately the interest isn't just about paying as little tax as possible, but getting these assets to grow as much as possible to advantage your beneficiaries in the way that you'd want as well. Common allowances available. See the annual ISA allowance being a very common one, £20,000 each year, being able to be placed in this tax wrapper with tax-free profits being given. Also available to individuals under the age of 18 is the junior ISA allowance of £9,000 a year. For investors under the age of 18. At the age of 18, it turns into a normal ISA. And while £9,000 allowance doesn't seem like much in the grand scheme of things at times, I'll go through an illustration later on which quite clearly demonstrates, I suppose, the power that some of these allowances can kind of provide for people. Pension contributions are also a very, very relevant discussion here because an individual can receive up to £40,000 in pension contributions gross each year, subject to their income being within certain thresholds. And what this means is that individual would benefit from the marginal rate tax relief that they would have received had they made the contribution themselves, but it can be someone else paying the contribution for them. So an annual gift in this instance could be used. Equally, if you're under the age of 18, you don't have to be working to have a pension. You don't even have to be 18 to have a pension. And in such instances, up to £3,600 per annum gross can be paid. And this only requires a net payment of £2,880 per annum, with basic rate tax relief then applied, grossing up to the 3,600, even if the grandchild is a non-taxpayer. So there's a very, very quick way to effectively get 25% bonus rather than 40% penalty on IHT instead. And this really comes onto this gifting example. So in a situation where you have an adult child who is a high earner, and they're caught themselves in a tax trap where they're losing their personal allowance as well as paying higher rate tax because they're earning 110,000. If, for example, the parents distributed £1,000 via their will on death to that child, and assuming that 40% inheritance tax was payable, the child would receive £600. However, had that parent decided that they were, for example, were going to pay £1,000 into their child's pension with no inheritance tax applicable, either because it falls part of their £3,000 annual gift exemption, or it might be out of regular income, or they survived 7 years past that gift, their child would receive £1,250 in the pension after basic rate tax relief has been applied. And then that child, via their self-assessment tax return, could receive another £500 in tax relief via the higher rate tax relief available and reclaiming some of their personal allowance that would have otherwise been lost. So the net result is £1,250 in a pension and £500 in the child's pocket. So in scenario 1, we're looking at a 40% loss. Whereas in scenario 2, we're effectively looking at a 75% gain from tax relief just by making that conscious decision of starting that planning conversation earlier. And this really brings me on to kind of the stages of wealth transfer and planning opportunities. So I'm going to run through, I suppose, some different life circumstances that you may find and identify yourselves with, and kind of some of the considerations that can be taken in these instances to start that inheritance tax planning conversation, or quite rapidly in some instances, particularly in later life. The first consideration really is for those with large estates that don't want to lose access to their capital. So it may well be that you're, early on in life, you may be in your 40s, your 50s, your 60s, for example, and you're wanting to start making considerations to inheritance tax planning, but you don't necessarily know how much money you need to actually, go through your retirement years, for example. Therefore, you don't want to give away capital because you don't want to reduce the value of your estate. One of the very common options is in insurance policies, again, making sure they're written into trust. This could be used to cover inheritance tax liabilities for the short term at a relatively low cost if you're in good health and you're covering, maybe for a 10 or 20-year term, for example, which would allow you to defer planning to a later point in time where you're then considering giving assets away. Or it could be used to cover the liability for example, with a whole of life policy. Loans, again, is a very, very powerful tool because you could loan capital to a trust, and it's an example I'll cover in a moment, with you having access to the initial capital loaned to the trust, but any growth belonging to the trust itself and immediately outside of your estate. Discounted gift trusts are a very clever type of trust. Effectively, the individual makes a gift to a trust, but they retain a right to the income. So the gift made has a discount applied to it for inheritance tax purposes, and that discount is calculated essentially on the benefit that you continue to receive from the income, because you are retaining a benefit from an element of the gift. You've not effectively given that away in the first place. So you would expect to see a discount, generally fairly hefty for younger individuals looking at these kind of trusts, but the discount may reduce when you're looking at making a gift in later life, for example, but wanting a level of income that's fixed for the remainder of your lifetime, subject to underlying investment performance as well. Business relief, again, something that you may personally qualify for with the companies that you own, but again, it's something that is available to all individuals, provided that you own the right assets ultimately, because it's the shares that you own in these qualifying trading companies that allow you to receive relief. So it may well be that in earlier life, for example, you want to consider an investment into a trading company that qualifies for business relief assets. So these could be shares in a pooled company that invests in qualifying trades, such as maybe companies that operate in solar farms or wind farms, or small to medium enterprise lending, for example, that qualify, and once held for 2 years, that relief is available to yourself as an individual, again with some AIM shares as well, but those are held within your own estate and there to benefit yourself as well should you need, because they're retained in your name and can be sold if required. So a loan trust, a bit of an illustration here for yourselves, really. In this instance, 500,000 is being loaned to a trust by an individual that's 60 years old. Within the trust, a investment bond is held, so this could be onshore or offshore, but what this means is that the trust itself isn't assessable for tax each year. That helps keep costs down from an administration perspective. And with bonds, you're allowed to take 5% tax deferred income available each year. So over 20 years of 5%, that is your 100% of your initial capital loan back. And in this circumstance, the individual takes an income of £1,000 a month. And assuming a growth rate of 4% per annum, so in no way guaranteed, but at the age of 80, that individual could have had £1,000 a month of income, provided it's spent. The trust loan that has been given from the individual to the trust is reduced from 500,000 to 272,000. Again, the remainder being accessible by the individual if required. And the IHT liability itself has reduced from 200,000 to 108,000, because effectively the growth of the underlying investment sits outside the trust, and the loan being paid back to the individual's estate is being spent because it's part of their income. Next, you could find yourself in a position where you're actually comfortable in giving away your assets, because we're able to kind of demonstrate that you have the funds that are sufficient to maintain your standard of living throughout the remainder of your life. So the £3,000 annual gift exemption each year could be used. Again, a smaller part of planning. And as James mentioned earlier, so gifts out of income as well is something that could well be applicable depending on your circumstances, and may be able to extend what you're able to gift out of your estate regularly and habitually each year. Gifts larger than that, that may fall outside your estate after 7 years, with gifts under 325,000 initially being offset by the nil rate band available, but effectively resetting every 7 years, or gifts of business relief qualifying assets, as James mentioned, could be used as well. And insurance can obviously insure the liability where gifts are being made, with taper relief potentially applying for gifts over 325,000 or the available nil rate band, and insurance can be taken out to cover the liabilities of those gifts over the shorter terms. Again, the spousal exemption being very, very powerful, because gifts between spouses and civil partners are exempt. And what this could allow you to do is, it may be that, say, one spouse or civil partner is older than the other and therefore more likely to survive a longer period of time, and therefore you could gift an asset to your younger partner, for example, for them to make the gift themselves to be more likely to survive the 7-year period, or potentially cheaper to insure in that circumstance as well. So we're talking about annual gift exemptions, and we've got £3,000 allowance per person. So let's take an example of 2 grandparents. So between them, £3,000 each, £6,000 in total. And in this instance, they have 3 grandchildren. and each grandchild, they wish to receive £2,000 per year until the age of 18, fully utilising the annual gift exemption per grandchild. Obviously, what to do with this is obviously a very, very relevant question, because ultimately it's about making these assets work hard for you and for your grandchildren's benefit as well. So let's assume that just £2,000 of the annual £9,000 junior ISA allowance is being used. It's invested, growing tax-free. Because they're generally going to be invested for the longer term, we tend to suggest using a slightly more adventurous attitude to risk, because the child in this instance can't actually touch the investment in any case, so their capacity for loss and the ability to withstand volatility is quite high. So we can look at a situation where they may be receiving growth of 4% per annum after factoring inflation as well. So what we see is a resultant fund in real terms that could be used for something like a house deposit on the age of 18 or 21 post-university and education and whatever it may be. So at the age of 18, the asset is belongs to the grandchild, and while it can be retained and continue to be invested, this fund, after that illustration of 4% growth and factoring inflation, could be a potential fund of 51,000, for example. So that's going a very, very long way to cover whether it's further education costs or deposit for a first home, all from gifts of £6,000 per year between 3 grandchildren. Another big change to someone's circumstances that would prompt obviously this kind of discussion as well is the sale of a business or an agricultural property, where you traditionally had these reliefs and therefore inheritance tax has not necessarily been as much of a concern. Of the sale of the qualifying asset, the relief is immediately lost, because those shares have to be held on death, or those assets have to be held on death. But as James mentioned, they can be regained either in full or 50% initially for the first 2 years, depending on how the asset is owned, by purchasing new assets that qualify for these reliefs. As James mentioned, the qualifying 2 years out of the previous 5 and held on death applies here. There are specialist companies that involve being able to allow individuals to use these reliefs, whether they're AIM-based or whether they're unquoted shares in companies. So it doesn't necessarily mean that you have to set up a trading company yourself to be able to qualify. There are specialist companies out there that are involved in these kind of areas, and they typically would hold things like whether it's wind or solar farms, lending, property development, or shares in AIM companies, for example, that allow you to qualify. Trust structures can also quite cleverly be used in this instance, as James had mentioned, being able to gift, shares of business relief qualifying assets into the trust itself, where you effectively only have to, make sure that you survive 2 years from that gift. And after 7 years, with them having already been potentially qualifying for inheritance tax relief in any case, you could then take the decision of what the trust should be holding going forwards, but knowing that actually you remove that kind of potential for liability over that 7-year period as well. There are instances where people may feel they've left inheritance tax planning too late. Generally, this will be later life. Again, as business relief qualifying investments have been mentioned, it's something that I'll reiterate again. The 2-year holding period really is kind of the thing that makes this such a important discussion nowadays, given that it is relatively easy to be able to purchase these trading companies. Yes, they are to be considered high risk investments because they are. They're not quoted, they're not daily, they don't have daily liquidity like shares on the stock market might have, whether it's FTSE 100 or something like that. But ultimately, they are invested into underlying real tangible assets. So there is an element of security there in some instances, but it does mean that you will find that sometimes it takes some time for assets to be sold, no different to selling a property, for example. James also mentioned deathbed planning, and again, there may be instances where you find that your estate is just over 2 million on your deathbed, and what you could do is you could make a gift, and even if that gift fails for inheritance tax purposes and is assessable at 40%, because you have made that gift, you have reduced the value of your estate, so it may well be that you're able to bring yourself under the 2 million threshold and be able to take advantage of your full residence nil rate band. This is the last kind of discussion point that I'll raise, but something that has become more and more common in recent years, which is that you may find yourself acting as a power of attorney for an individual, and the donor, you may be able to sort of say, actually, we feel you've got sufficient funds for care costs, and you want to make considerations for inheritance tax planning as well, because they may have wanted to, had they had the capability to do so, and with considerations to their beneficiaries. However, as a power of attorney, you're generally not allowed to give away money, aside from your general customary occasions, because it's generally not going to be seen as beneficial for the individual for them to give funds away from their own estate when they may need them for costs in later life, for example. Any large gifts being made to individuals or trusts would effectively need permission granted by the Court of Protection, which is relatively unlikely in most circumstances, because obviously you've got to prove it's in the donor's best interest to do so. However, and back to business relief qualifying investments again, they are investments in their own right. They're individuals that hold in that individual's own name. So those investments continue to be accessible by that individual. So if they were required, you could sell them to benefit the donor. And that really is very, very powerful tool. One of the few options that are available on the kind of inheritance tax planning conversation for powers of attorneys now as well. Lastly, I suppose the point about choosing the right financial products. The inheritance tax planning, intergenerational wealth planning, the discussions involved in transfer are complex, and sometimes they're the kind of irreversible without consequences as well. And the last thing that we'd want to see is action being taken that also has unintended consequences. So this is where the kind of joint conversation between accountants, financial advisors and solicitors are helpful to ensure that the right kind of solutions are put in place, with each of us having our own individual specialisms to form part of a plan. For example, generally be solicitors that write trusts, for example, and accountants that may be involved in the maintenance of such, and ourselves that would be involved in the underlying investments within the trust to ensure that they're kind of there to benefit those that you want to most going forwards as well. And that covers off the remainder of my section, but I'm going to pass back over to Patrick, who's going to deal with, if we've got time, some of the questions and answers session as well.
Yes, thank you, Dominic, and thank you, James. As you can see, for the audience, we have pretty much run up against our time. Now, we do try and keep these within the hour where we can, because we know people have other things to do. There haven't been a huge number of questions, so I think we can probably deal with a couple of them, one of which came in beforehand and one of which has been asked during the session. We can deal with them together because I think they're covering the same topic, and that should probably bring us up to the end of our hour quite successfully. So the question is, and I think this may be more for James than for Dominic, but feel free to pitch in if you think you need to, Dominic, relates to the interaction between inheritance tax and capital gains tax. So there's 2 points there. One question that came in before we started, in fact, by email, was related to this issue that James covered off, where in a married couple, for instance, which spouse is likely to die first. Unfortunate circumstances, but to see silver linings in them is something that sometimes you can do. And with capital gains tax, James alluded to that, how we can transfer assets to the person likely to die first and get a benefit. And the other question is, looking at the similar point, the interaction between inheritance tax and capital gains tax. If an estate pays inheritance tax and then assets from in that estate pass to a beneficiary, what value do they receive that asset at, and what tax would they pay when they come to sell it in due course? So I think, James, that's probably one that you were covering pretty much in your section.
Yeah, so the second question, taking the second question first, what value do beneficiaries receive assets at? And it's the date of death value. So, someone leaves a house to their beneficiary, house is valued at $500,000 on the date of death. That $500,000 becomes the base cost for future capital gains computations for the recipient. I hope that answers that one.
I think the questioner may have been referring to the fact that the £500,000 is subject to inheritance tax, and so after inheritance tax, there's obviously less than £500,000 left.
Oh, right, yeah.
But the point is that the value for capital gains tax person for the recipient is still the £500,000 in that case, isn't it?
Yes, agreed. Yeah, that's correct. And the first question, Patrick, was around the sort of deathbed stuff. The
deathbed planning, yes, which I didn't really cover, did I, in the end? Yes, I think the question there was, it sounds a bit cute from some points of view to transfer an asset to someone just before they die with at least one eye on a tax benefit, namely the capital gains tax. And I think the questioner was really just querying whether that was something to be concerned about, the fact that it is a bit close to the knuckle, perhaps, in terms of planning.
Yeah, this does. I mean, it's a question that is often asked. I mean, thankfully, this sort of thing crops up, a couple of times a year. But when it does crop up, clients will typically say, "Well, is this a bit too good to be true?" Exactly as you said, Patrick. No, it's fine. Put simply, HMRC are clear that the rules are there to be used. And interestingly, when the general anti-abuse rule was brought in, well, I'm going to say getting on 10 years ago now, in their guidance, this particular planning was specifically mentioned, and it was confirmed that it's absolutely fine, well within the rules. It's what the rules are there for. Spouses are entitled to transfer assets between themselves, and the tax consequences follow. And in this case, the tax consequences are an uplift in base cost on first death without any inheritance tax being payable.
Thanks, James. Well, we're 2 minutes past 11 now, so apologies for those that have remained on, that we've slightly gone over time. I think we probably should stop now. I hope you found that useful. I hope the fact there weren't a huge number of questions is because we explained it so well. But please do fire in questions if you do have them, and we haven't been able to do so. And we look forward to welcoming you to our next webinar in a month or so's time, which I think is in relation to family-owned companies, for family investment companies, but I may be wrong, so don't quote me on that. So thank you very much to all those who attended, and we look forward to seeing you next time.